Hi, my name is George Watkins, and I would like to share with you a very simple way to understand life insurance. If you like what you're about to see, share the concept and the video with your family and friends. Or if you need additional information, you can call me toll free at 1-866-671-6875 or email me at gjwatkins@att.net. You can also see other videos I've made on YouTube at www.youtube.com/GJ Watkins Jr. Now, let's talk about life insurance. Most of what you need to know to purchase life insurance is captured in this one slide. So what I intend to do in this presentation is to take a step-by-step approach to explain the components of this slide. Okay, here we go. For any life insurance policy, there are premiums. You can pay annually, semi-annually, quarterly, or monthly. Fees are deducted from each premium to cover administrative costs. What remains after the fees are deducted goes into the cash account, which essentially you own. Cash accounts only exist in permanent policies. Term policies do not have cash accounts. In addition, there is another cost that is deducted to cover the death benefit, called the cost of insurance. So you can see thus far, from your paid premiums, the life insurance company subtracts fees and the cost of insurance, and the remainder goes into your cash account. The universal life policy is the most flexible of all permanent policies. Most importantly, the premiums are flexible. The lowest you can invest for a given death benefit is the minimum premium. There is also a target premium. In virtually all cases, the target premium is sufficient to sustain the policy beyond your end of life. And in most cases, payments can stop after 20 to 30 years and still have sufficient funds in the cash account to sustain the policy beyond your end of life. Furthermore, there is a maximum premium that the IRS allows, known as the maximum non-MEC premium. If you exceed the MEC limit, the policy becomes a MEC, or a modified endowment contract, which in essence means if you borrow from the cash account, your growth proceeds will be taxable. If you stay within the MEC constraint, you can structure your policy to obtain proceeds from the cash account tax-free. Now, for the universal policies that I make available to my clients, in addition to the death benefit, there are living benefits. They are called living benefits because you can have access to these benefits while you are alive. You don't have to die to use it. The first living benefit is called terminal illness. Upon diagnosis of a terminal illness, you can access nearly all of the death benefit to use as you wish. If you become critically ill, that is, if you experience any of the following: heart attack, cancer, stroke, ALS, kidney failure, major organ transplant, or blindness, then you can get access to some of the death benefit. Chronic illness. If you are unable to perform 2 out of the 6 activities of daily living, or if you are cognitively impaired, you can gain access to the death benefit. Also, there is disability income available if you are sick or injured and can't perform your job, and your premiums can be waived if you become disabled. There are emergency funds available where you have access to the cash account when necessary. And finally, tax-free retirement, where you can gain access to the cash account tax-free. Now, if the premiums exceed your budget or you just can't afford what you think you need, then invest in a policy with a smaller face amount. Later, when your financial situation improves, invest in getting some more, and again some more, until the sum of the series of smaller policies equals the asset coverage or savings capacity you believe you need. So that describes a permanent policy, namely a universal life policy. Now, another kind of policy that may meet your needs is a term life insurance policy. A term life policy has a death benefit, and in most cases, not much more. Typically, they are fully underwritten and require a full exam, which often equates to being the toughest to qualify for. However, the investment in premium is usually less than other alternatives. Then there is the mortgage protection term. These policies typically have no medical exam, and because of that, the underwriting process is quick. In addition, you can add some living benefits, such as disability income, waiver premium, and critical illness. Also, return of premium is available in many mortgage protection term policies, where at the end of the guaranteed premium period, the client receives all or most of their paid-in premiums tax-free. Now, with that level of knowledge of term, mortgage protection term, and the universal life policy, what should you choose? Well, the offering can consist of the following. 1. A term life insurance policy with reasonable premiums. 2. Term mortgage protection insurance with living benefits and the potential to have all your paid premiums returned tax-free. Number 3, universal life, where in addition to asset protection or the death benefit, you also have a number of living benefits and tax-free retirement income. Or finally, a combination of any of the above. For example, a client may like all of the attractive benefits of a universal life investment, living benefits, tax-free retirement, etc., but in addition wants additional death benefit protection at a reasonable premium offered through life insurance. Now, with that tutorial, you probably know more about the different types of life insurance than 97% of the general population. Now, you may know enough about life insurance to make a decision on what's best for your situation. Or you may have additional questions or need additional information. If so, call me, 832-515-9154. You can always email me at gjwatkins@att.net. Also, visit my website, www.abdfinancialservices.com, or check out my other videos on YouTube. Talk to you later.